a lot of people in the insurance industry understand and acknowledge that behavior is phenomenally important. One executive said to me that they only recently understood that they're not insuring property, they're insuring people. So the soft skills, the psychology, the incentives are phenomenally important. And when you look at some of the statistics, I said that law-abiding citizens, like the people in this room, presumably, let their demons loose when it comes to insurance. You got to say, well, there's something then at the behavioral level, and this is costly in the order of hundreds of billions of dollars. Distrust is eroding the product, and it's costing staggering sums of money. And it means that you don't know that your claim's going to get paid, et cetera, et cetera. I'll give you one example of an experiment that Dan did, but there's so many of them, and it's just kind of interesting to get a sense of the impact. Is that okay? I'll digress for 2 seconds.
Absolutely.
So one is an experiment known as the public goods game. So people are probably familiar with the prisoner's dilemma. This is a variant of that kind of experiment. And the experiment goes like this. I've got 10 people around the table. I say to each of them, listen, guys, you can put up to $10 into the secret envelope. I, as the moderator, I'm going to take all the money in the pool. I'm going to double it and divide it by the number of participants. So sure enough, everybody puts in $10. I take it, I have $100, I double it. Now I have $200, I divide it 10 ways. I give everybody back $20. Everybody's smiling. I say, okay, guys, we're going to play the same game again. Nothing changes. Everybody puts in $10. Cycle repeats. They make $20. Everyone's winning. On cycle 3, one smart aleck, we'll call him Ian, decides that he's not going to put his $10 in because he's a smart aleck, and he figured out that if he doesn't put his $10 in, he actually beats the system. And what happens then is that there's $90. I double it to 180. I divide it by 10. I give everybody $18 back. But you've got $10 still in your pocket because you didn't put it in. You're $28 up. Oh, you're happy. Problem is that when round 4 comes round, Dan and Kevin don't put their $10 in either because they don't want to be their suckers. And by round 5, there's no money in the kitty. And you find that the point of equilibrium in the system is 0, even though if there was trust in the system, the point of equilibrium would be everybody making $20 every time. And that is a simplified game theory kind of experiment, which I think is, I am simplifying, but is illustrative of what's happening in insurance. Because of the behavioral dynamics, you end up with a system that becomes prohibitively expensive, incredibly cumbersome, and these things are structural and they're built into the human psychology because trust is missing, and that drives behavior in the way that I just described.
So without the trust, you have a bigger incentive to kind of pursue less than ideal behavioral aspects, I guess endeavors, right?
Yeah, and you get people embellishing their claims, you get the tit for tat, and you get a vicious cycle, which, as I say, corrodes the experience, erodes trust, and adds cost and complexity into the system. So to our way of thinking, technology is absolutely just one piece of the puzzle. Much more profound and much harder to change are the psychological dynamics, but it's doable. You know, micro-lending in the developing world is a phenomenal business. So you've got places like in rural India where there's these microfinancing. Grameen Bank has loaned out billions of dollars in microfinance. Their repayment rate is 99%. No FICO scores, no enforceable contracts, no legal systems, no collateral, 99% repayment rates. And you take people with the same DNA and you stick them in America with legal systems and claims assessors and FICO scores, and 38% of the money goes out of the window through fraud. So thinking thoughtfully about these kind of behavioral dynamics can be transformative.